Okay, in this quick video, I'm going to show you that you can actually make income by owning gold. People say that's impossible, but I'm going to show you how it's very possible. And I've done it. You can do it. It's by selling options on exchange-traded fund positions. You see, 90% of options expire completely worthless. And options are priced by volatility and time. Each day that goes by, they fall in value if you own one. So we can sell options. Now, if you don't know what an option is, it gives you the right to buy or sell a stock. We're going to talk about call options. Call options give you the right to buy a stock. So for example, if say Walmart was trading at $20 right now, and you thought Walmart's going to go up to $25, you can buy an option to buy Walmart at $25 for a very cheap price. The option could cost, let's say 50 cents. And if it gets up to 25, that option will be worth a lot of money. And every point higher than 25 will go up a point in value. So people see options as a way to take a little bit of money in a trade and try to make a whole lot of money. That's why people are attracted to purchasing options. And if they decide they can exercise the option, if they bought the Walmart option with a $25 exercise price, which is called a call, and Walmart were to go up to $30, and they were holding that option, they would have the right to call in that person's stock, and they would have to they would be able to buy the stock from the person that wrote the option to them. So that's what options are. They're a contract to buy a stock from somebody or sell a stock to them. And calls are options about buying stocks, and that's what we're going to talk about. So it's the covered call trade that allows us to sell options to other people out there. And if the options expire worthless, then we just take pure profit from that. And they're just stuck with a worthless option. So how do you do that? Okay, let's use the Walmart example again. Again, let's say Walmart's trading at $20, but this time we own Walmart stock. And we're happy to own the stock. We're getting some sort of dividend. We believe Walmart's going to go up in the long run, but we don't really think it's going to go up next week, to $25, or next month to $25. Maybe Walmart stock's falling, or it's in one of those phases where it's going sideways. Or maybe Walmart really doesn't go up that fast. Maybe we think it's going to go to 22, not to 25. But there's people out there that want to make a bet that it's going to go to 25. They want to buy an option to do it. Well, we can sell them an option. We own the stock, and we can sell a call for 25. This is called a covered call because we own the stock. It's the simplest option strategy. It's all I'm going to talk about in this video because I like to keep things simple. And the simplest strategy is the one that tends to work the best in the long run. And remember, 90% of options expire worthless. So the idea is, okay, the call option's at 25, and let's say the option has an expiration date of 4 weeks on it. So the stock's got to go above $25 for the person we've sold the option to benefit from this. If it goes up to 28 or 30, then they may force us to sell our stock to them for $25. They'll exercise it, call our shares in. So that's the risk we're taking, the risk of losing out on potential gains if Walmart stock goes up higher quicker than we expect. If Walmart stock, though, falls in value or doesn't go up to 25 or stays where it is, this option will expire worthless. It will generate a profit for us. So, again, it's all about time. It's all about the time. They're betting the stock's going to go up fast enough to reach their target, and we think it won't. And remember, 90% of the time, these people buying these options find out that the options don't do what they want in the time they want to do it. They expire worthless. Why is that? Why does that happen? Well, the dirty secret or truth about options is that they are sort of like a casino. If you were to walk into a casino and go into the sports bet room and bet on football games or basketball games or whatever, usually the casinos try to create the odds so that they're in their favor, but just good enough to entice people to want to make bets. That's really what goes on in the options market by the people who sell the options. They try to make things as attractive as they can, but the odds are usually in favor of the people selling the options. That's how the options market's just skewed, you know. Now, there's all kinds of things you can do with options, all kinds of complicated strategies, but again, this is the simplest strategy, and it's a way to sort of like be the casino and make income off of the stocks that you're holding. In this case, exchange traded funds. But again, we want to keep things as simple as possible. This isn't a strategy to try to get rich quick. This is a strategy to just try to make a little bit of income. You know, when you think gold's not like skyrocketing instantly, and usually markets are not skyrocketing overnight. They just really aren't. Even in bull markets, things usually just go up 1% a month. You know, that's like a great gain in the stock market. If it goes up 1% a month, by the end of the year, that's 12%. Percent a month on average is what I'm speaking of. And basically the same thing applies to gold. Of course, at the end of runs, gold can go up at a very high rate. We saw silver double in 2011 in a very short amount of time, but normally that doesn't happen. And if you do get such a crazy move, it's not really a bad thing to be doing some selling. But again, the risk in this strategy is that you write an option and it goes up and it gets called in. But you can put the odds in more in your favor that that's not going to happen by doing the two things on this slide: selling covered calls that are pretty far out in price. You know, it's the odds of it reaching that price level, even if it goes up, are kind of slim. And then to sell the covered calls that are going to expire fairly quickly. People can buy leaps that go out 1 year, but we're really in this strategy, I'm looking to just sell covered calls that are going to expire within 3 to 4 weeks typically, really never beyond that. And that puts it so we have a very high likelihood that these covered calls are going to expire worthless and just provide us a little bit of income. You know, not a huge amount because, you know, the odds are so much in our favor that, you know, people aren't going to, they're going to just put, they're going to pay small amounts of money to try to make a big return. It's almost as if we're the racetrack and we're selling the 50 to 1. Someone wants, we're selling a 50 to 1 odd horse bet to someone. They're paying $1 to try to win 50. You know, the odds of them getting that are very small. The odds are we're going to make money, but just a tiny amount of money. But that's good because you can repeat it over and over and over again. So let's use an example. GLD, the gold ETF, as I do this video, closed at right under 117. So if we look at that chart, I'm bullish on GLD at this moment. However, as I'm doing this video, it is in a sideways pattern. It's likely to continue to be in that sideways pattern. Resistance is really 122.5. Support, you know, maybe it's 115, but its support doesn't really matter. We're looking to sell a covered call at a high price. Well, the last high was 125 in January. Before that was 127.5 in 2014. It would take a move to get to 125 from here of almost 6.8%. Gold closed around 1220 it was. That would take gold up to 1303. Okay. Now, the most liquid option time is the third Friday of every month. It's called Expiration Friday. Those are the most widely traded options. Those are the most I like to sell, and that's what we're going to look at. So we're saying we got a 3-week time frame right now on this option we're thinking of selling. Now, I really don't think that gold's going to get to 1,300 in 3 weeks. I do think it's probably going to get there though in the next couple months. Gold stocks could break their high of March, in April, as I'm doing this video. Gold stocks are in a better position to make a new high than gold is. Gold stocks are actually leading and performing better so far this year. So there's a good chance that the gold stocks are going to break out first anyway. So gold at 1303 would be GLD essentially at 125. Well, let's say let's try further out. Let's try 127.5. Just in case gold does break 125, we'll put it way far out. So how far is 127.5 from 117? Now we're speaking 8.9%. That would take gold going to 1330, basically, giving us even more room. I feel pretty confident that gold's not going to make it to that level. So let's see what we can do if we sell options for 125 and 127.5, or maybe even further out than that. To do that, we're going to go to Yahoo Finance, and you can type in a symbol of whatever you want to look at, then options, to see how much options are being sold for. We're looking at the calls, and we've got the expiration date of the third Friday of the month here, April the 22nd, and these are the closing prices. These are the strike prices for the calls, and we wanted to look at the 125 calls. They closed at 19 cents. So if we took the risk of gold, we can make 20 cents per share on an option trade selling the covered calls, and 20 cents per share is not a huge amount of money when each share costs right now 117. That's almost a percent. Almost a percent. It's not huge. Almost a percent. If you did that every month, though, it would add up to 12% over the course of the year. That's a big, nice income chunk. Now, there is a risk, though, if you did it this close to being in the money, that at some point, one of those 12 months, the stock's going to get called away. So let's see this 127.5. They did trade at 20 cents, but really that was during the middle of the day. The ask closed at 13 cents. And it would take a substantial move in gold to get that high. You're talking about a return, though, 12 cents divided by 117 of 0.1% over the course of a year. That's going to come out to 1.2%. Well, if you think about what CDs are paying today, you can't really get 1.2%. And with gold, you got something that's going to go up in money and most likely in a bull market and do very well. And this is kind of like some juicy bonus to get from it. But there is still a risk that it gets called away. So you can go further out, and do it for 128 or 130 even, or just make a literally small amount of money for 4 cents. But hey, money's money. That's a strike price of 135. And if we look at the chart, 135 is so far in the sky that I think it's pretty much impossible that gold's going to get to 135 within the next 3 weeks. I'd say that's impossible. And I can make a nickel a share. Well, that doesn't sound like much money, but it's really essentially free money, you know. There's nothing wrong with free money. There really isn't. A nickel isn't much. Let's say we did it for 130. Still pretty much, I think, impossible to get to 130. At the 130, you're talking 7 cents a share is the ask on the last close here. I still think it's pretty much impossible. Why not get paid 7 cents a share for just holding this? It's income. You know, they tell me on CNBC you can't make income owning gold. Well, I'm saying you can, and this is how you can do it. And you can do this with all kinds of ETFs. But it can be, you know, the more volume there is in ETF, really, the easier it is to do. Let's look at GDX. I really am more hesitant to do this on GDX at a close strike price because I think GDX could possibly break out in 3 weeks. And if it broke out in 3 weeks, it could go to 123, theoretically. It's very unlikely to get to 126 in 3 weeks or 124 or 125. But, you know, let's take a look. What can we do with GDX in 3 weeks? GDX closed at 20. $123. It's going to really be tough. There's not as much liquidity in the really far out of the money options. They really want, here's the trading volume. Options closer in the money, like 122.5. They closed that on Friday. That's way up here. Remember I said 123 is like really a theoretical limit. You know, you can get 2 cents. You basically, at this point, kind of have to throw the order in there, look for a bid to hit, and I really need to be looking at this during the live trading day. And, you know, the 124 options did sell on Friday for 3 cents. 124 is up here. Again, I really don't see how GDX is going to get to 124 in 3 weeks, even if it broke out. It's just unlikely. If it breaks out, it's probably going up to 122, 123. Speaking of 3 weeks time period, I do think it's going to make it to 124 this year, and it could theoretically do it in a couple months, but not in 3 weeks. So we could make, essentially probably 3 cents on that free money up here, and there's a bid and ask of 15 cents at 124.5. So again, it's not way far out of the money. Doesn't really have huge liquidity and volume on this symbol. Other symbols, it's a different story. So if you look at something like SPY, there is more trading volume, way far out, all the way at 211, and it's only at 206. It's unlikely to make it that far. And if you look at Dust, these ultra ETFs, they're so volatile and crazy that, there's people buying Dust ETFs at $5 for a nickel, and I wouldn't own Dust. I think it's a crazy one. Let's look at the other ones, JNUG and these others. JNUG's at 77 basically. And you can see these are, 77 for JNUG is like $12. The higher the price, the more expensive the option can be. That's the bid and ask. So anyway, you kind of get the idea here. But basically, the farther out you go, the cheaper the option money you can collect, and so forth. But GLD is extremely liquid. It's one of the most widely traded things in the options market too. So it's really easy to get income in GLD by selling options. You can do it in GDX too. Really, when it comes to GLD, it's fun to do it every month. When it comes to GDX, I kind of do look more at what position we're in. When we look like we're going to break out and have a big run, it's not as exciting to try to do it. But after a run, when GDX gets overbought, like say it was a couple weeks ago or the beginning of March, then yeah, it's more fun to sell calls in it. So you kind of have to use some judgment on how likely is it to go up, or do you even mind if you get sold out, and you don't have to do an entire position. Maybe you got trading positions and so forth. So just want to show you how this is a conservative options income strategy. It's one I employ sometimes in ETFs I own, and with GLD it's one that's really easy to do. So that's what this video is about, and we're headed to the next series of videos. We're going to talk about how much gold should someone actually own. If you're using some of these funds we talked about in this module, how much of a position in GLD should someone really have in their portfolio? So that's next.